Hi there, Dan Kerr's DK Analytics. It is July 23rd, 2020. I'm chiming back in from Niederwening in Switzerland. My topic today is precious metals start blinking red. Let me go over some valuation metrics. The US dollar, the DXY index stood at 94.84. The balance sheet of the Fed almost back up to 7 trillion. The U.S. 10-year yielded 0.58%. The S&P 500 stood at 32.72 morning hours on July 23rd. Oil stood at $41.72 per blue barrel. Gold at $1,882 per troy ounce. And silver at around $23 per troy ounce. With the dollar index below 95, it's down 7.7% in 4 months. This could be a slippery slope. The Fed's balance sheet in the interim is again expanding, and gold, and especially silver, have started to surge in US dollar terms, with silver's rise since its sharp sell-off in early March of this year to $12.27 per troy ounce. It's rallied over 85% from there. I'm going to argue or claim here that you cannot engage in ever more flagrant redistributionism, be it cronyism or welfare, shut down vast swaths of a global economy over a virus that has claimed only 0.01% of the world's lives and 0.04% of US lives, probably closer to 0.03% if the coronavirus related deaths were tabulated correctly. But you can't shut down a global economy over such a virus that, said differently, constitutes an OECD citizen health risk roughly similar to getting into a car and dying behind the wheel or as a passenger. You can't print untold amounts of money to pay those going out of business or losing their jobs thanks to this virus or this pandemic policy. We used to just shelter the frail and the aged and the vulnerable. We didn't lock down the entire joint. You cannot finance record deficit spending in heavily indebted public sectors as joblessness and bankruptcy soar thanks to shutdown, lockdown policy diktats. You cannot allow blue state cities across the U.S. to stew in mayhem, vandalism, racism, and destruction. These cities have become a virtual war zone from coast to coast. Short, you can't do these kind of things or allow them to happen, have these policies or their lack of, and expect a good societal, political, or economic outcome. What you can expect, most especially in the U.S., given its outsized problems that a dollar valuation crisis would only worsen, is stagflation that threatens to make the 1970s style stagflation or the 70s stagflation experience look like a warm-up in comparison. I've gone over this quite a few times, both before and after the disastrous coronavirus policy response, the tyrannical coronavirus policy response. I've also gone over this in a January 2020 post 56, it's on the site, on DK Analytics site, which covered how silver fared during the stagflationary 70s and how silver is likely to fare in the 20s. For more recent color on that despotic virus response disaster as regards the U.S. and arguably much of the world, please see my two recent posts, post number 62 and post number 63. With U.S. elections a bit over 3 months away and the original coronavirus stimulus payments having run their course, look for more multi-trillion-dollar U.S. government spending out of an empty pocket, financed, of course, by the Fed, by its money printing. But don't just look at domestic shores, for there is a pan-European stimulus package to offset the economic cardiac arrest triggered by the coronavirus policy response, also in the works on the continent. That is a stimulus package. That stimulus package, the corona policy offset, if you will, is called the EU Recovery Fund. And at 750 billion euros, about $860 billion, it's not a minnow, and it may well be the first pan-European installment. Once caution and national constitutions are pushed aside or twisted further, one can rationally expect European sequels, especially given policy responses. Just as in the U.S., the EU Recovery Fund is likely layered with all kinds of pork that Kentucky Republican Representative Massey unearthed for the U.S. stimulus package, the $2 trillion U.S. stimulus package, including possible pork for bailing out Wall Street or the European equivalent. Also, like in the U.S., the European Recovery Fund will ultimately be financed with money printed out of thin air by a central bank, in this case the ECB, of course. That is, if the German taxpayers don't have to foot the bill, which won't sell well, politically speaking, at home. Finally, and again like the U.S., the continent stock markets have been expecting fiscal largesse on top of a 35% expansion in the ECB's balance sheet in 4.5 short months, and sustained central bank NERP and ZERP, negative and zero interest rate policies. And the continent stock markets have rallied sharply on it, on the fiscal and on the monetary and coming fiscal response to the corona lockdown, shutdown. In fact, the Stocks Europe 600 index has added a whopping $3.5 trillion in market value since the mid-March lows, when the coronavirus, and more to the point, the coronavirus policy response hit hard and deep. Yet, economic fundamentals are not keeping up with new stock valuation bubbles rising out of the coronavirus response ashes. That is, namely thanks to increasing monetary and fiscal largesse in typically unprecedented terms. In the monetary largesse, obviously, doesn't only include the balance sheet expansion, but it includes these sustained ultra-low interest rates fueled by, to a large degree, the monetary expansion at the longer end, and of course at the short end by the rates the central banks control directly. That makes stocks in present value terms and bonds that much more valuable. Well, as economic fundamentals are going a different path from stock and bond valuations, let me cite a few cases, such cases, and let me cite them on either side of the Atlantic as well as globally, which will hopefully highlight the once again widening disconnect between stock markets and the underlying economies. Never mind government bond bubbles typified by negative real or negative nominal yields, juxtaposed against record deficits, debt, and money printing. I call them junk bonds without junk bond yields. And again, it's an OECD-wide phenomenon. Stock and bond bubbles. Here's some cases that highlight that the economy is going south and the market's going north. stocks and bonds. 83% of German firms with international exposure recently warned of collapsing revenues. German industrial production recently slumped by 19.4% year over year. The euro area consumer recovery paused in June, while U.S. retail spending was corona stimulus policy driven. That is, stimulus checks driven. Last week, 32 million people in the U.S. were on state and or federal unemployment, the second highest level ever. At July's beginning, U.S. private sector jobs fell back to December 2013 levels of 115 million private sector jobs in the U.S. And all that happened in just 4 months. It triggered a net loss of 14 million private sector jobs. There is no V-shaped recovery in store for airlines. Ticket sales are again sliding. United announced a 36,000 involuntary furlough initiative a few weeks back. More recently, a few days ago, Delta's Q2 passenger revenues plummeted by an earth-shattering 94%, resulting in a huge loss and questioning this airline's ability to sustain operations anywhere near current capacity going forward. And Delta is not alone. U.S. Services Purchasing Manager Index, the PMI, is still below 50% in June as employers continued to shed jobs. The U.S.'s May overall trade deficit, goods and services, grew by 9.7% to $54.6 billion, which is the widest deficit since December of 2018. Exports fell by 4.4% and imports slipped by 0.9%. Global capex, finally, are plunging by 12% year over year, the latest data point, which is worse than during the great financial recession until this one. And this is also a sign that the global recovery will be either underwhelming or short-lived, to the degree that there is one. Let me drill down a bit on Q2 EPS in the U.S. that are starting to come out. Once again, EPS are typically a single digit, say 5% residual of the top line, sales line, with bottom line numbers typically displaying wild swings given the leverage, given the cost structure element that's fixed, at least short term. The bottom line swings wildly with just a small top line change. And the macro, the economic growth feeds back down to the big corporate level as well, to those revenues, which broadly mirror the macroeconomic growth in nominal terms. But what we've got are wild swings, that bottom line residual, with U.S. GDP set to collapse by roughly 50% year over year in Q2. And a stout recovery being as unlikely as another lunar landing anytime soon, bloated, financially engineered, stock buyback driven, debt laced, EPS are likely to get walloped and then stay down for the count. EPS have to implode, and sooner or later, shareholders will turn from cheering on yet more money printing or more fiscal stimulus to 40 or 50 or 60 PE ratio agoraphobia. That is, as EPS wilts in line with economic reality. By the way, we're already at a PE of 33 on S&P 500 EPS, with only 4% of companies having reported Q2 results. And those companies are typically money center banks, that is, Wall Street profiting handsomely from both stimulus handouts, you read right, you heard right, and from stimulus execution premiums handing out the dough, fat fees. Think of what will happen as other industries start reporting. The current Q2 2020 S&P 500 year-over-year EPS hit should increase substantially from the 46% registered so far. In fact, if we take a look at the '05 earnings peak, in which earnings continued to fall through '08, in fact, they fell like 82% from the '05 peak, and then took till 2011 to get back in nominal terms to the '05 high watermark. This time around, given the additional baggage that we have in all directions, it could take even longer to regain the high watermark EPS level of, say, last year. Let me add another dimension that the stock market isn't really considering, even though polls suggest it's likely. What if Biden wins? And before I continue, I want to say that I expect Trump to win, despite the press takedown since he was elected president, and what will surely prove to be record vote rigging ahead of us. For flavor, for a small preview of truly Banana Republic happenings in the upcoming election, where they want to do mail by home or by home ballot, they're sending it in by mail. Consider that in the 2012 election, where Obama was up against Romney, that Romney did not achieve one vote in any precinct in the city of Philadelphia. If you don't believe me, look it up online. I think we're going to see a lot more of that, and 3 guesses which party will benefit. It starts with a D. Well, so what's Biden's plan for America? Why would the stock market have to start to price this in? Why isn't it? I don't know that. But most people believe Biden's going to win. Again, I don't. But what is Biden's plan specifically? Why is it so toxic to shareholders and bondholders and property owners and small business people? Well, how does open borders, massive social benefits / welfare for third world amnesty recipients that will act as an even bigger magnet to relocate to the U.S., this policy, this democratic policy of providing social benefits wide-based, from health care to schooling to maternal care, you name it, to third world immigrants. Well, in short, who isn't going to want to come to America that isn't in a good economic position? Well, that coupled with massive reparation payments that the Democrats, if they also take the Senate and keep the House, want to execute for slavery, all right? That is, people who were slaves, that the descendants of those get payments, get reparations. Well, no one currently living is responsible for any of that. Where would this end? It's insanity. But these are the kind of things that a Biden win would possibly usher in. He'd also want to defund the police further, stoke anarchy and destruction of property, raise taxes, and increase debt and money printing to an even greater degree as the public sector flourishes, bureaucrats do well, and the private sector / Main Street gets eviscerated even further. How will this help the private sector? Private sector jobs, growth, productivity, price stability, or already over-leveraged balance sheets at both public and private levels? The answer is it won't. It'll just make things worse. Yet stocks are at nosebleed levels just going into 1/4 of the virus response earnings debacle, just 1/4, right? We're at 33 times already. And many bonds have negative yields. In short, an even worse outcome beckons if Biden is elected and the Democrats keep the House and possibly retake the Senate. Even a worse outcome would be guaranteed than the current U.S. horror show reality, which isn't even being priced in. Speaking of balance sheets, both the world and America are drowning in debt, with over 250 trillion in global debt, or roughly 3 times the globe's GDP. Sensitivity to higher interest rates couldn't be more pronounced. In America, with aggregate debt at all levels, above $77 trillion. That's nearly 5 trillion more than a year ago. 5 trillion more than a year ago. Any market increase in the interest expense would completely choke off the economy. We couldn't do Paul Volcker tough love, all right? As you might recall, he cranked the Fed funds rate up to 21%. When you think about this, however, do recall that we always have boom and bust. We always have reversion beyond the mean. That is, bonds and stock prices, valuations go from boom today, near zero yields, 33 PE just on the S&P, similarly high PEs around the world, if a bit lower. We go from hugely overvalued stocks and bonds to hugely overvalued. That's the boom bust. That's the cycle. That's the manic depressive behavior of markets, yes, of people. Think about where we could go from current stock market valuations, PEs, and bond market valuations around zero yields, nominal yields. This dynamic, given the global debt in excess of 250 trillion, nearly 3 times global GDP, this dynamic, this valuation disconnect holds true the world over. And even though we continue to add debt substantially faster than economic growth, especially after the coronavirus policy breakdown of the economy and of civil rights. Money is also being financed in ever larger numbers to, in essence, issue the necessary bonds to pay for living beyond our means, to pay for the shutdown-related economic destruction. So all these things are going at a record pace, are trained to insanity, all right? In this process, I'm going to argue where you have a shutdown economy, where more and more economic participants are becoming in tune with increasingly persistent inflation in must-have goods and services, not luxury items, but must-have goods and services. Rising price inflation statistics are bearing this out. When you choke off economic activity, laying supply chains and small businesses to waste, some 47% expect to close permanently in the U.S., where roughly half of all Americans are employed, by rewarding would-be employees with higher unemployment insurance than their former wages or salaries provided, and then printing unfathomable amounts of money, it is clear that a whole host of vital goods and services are going to get more scarce, just as fiat money keeps getting increasingly prevalent. So, more and more economic participants, from consumers to corporate treasurers or CFOs, will move to buy essential goods and services prior to an anticipated price increase. This it is, starting to push up or levitate money multipliers, which, when combined with surging monetary bases, is how monetary inflation heaped on top of economic and financial destruction is spelled. In short, print a lot of money, close down the economy. What do you expect? This fact, our economic policy, our fiscal or monetary policy, is also how one spells how do I avail myself of extremely scarce precious metals that have always maintained their purchasing power. By the way, silver mining output has lagged silver demand by an average of 23% for over a decade. In addition, there is relatively little salvageable, that is economically viable, reclaimable silver. The consensus of how much above ground silver that can be reclaimed makes economic sense to do so. In other words, it's not a tiny bit in a cell phone someplace, is 2 billion troy ounces of above ground accessible, economically viable silver that can be melted or reclaimed. I figure with all the silverware and similar reclaimable stocks, those 2 billion troy ounces of silver might be 8 times higher, based on a study that I once looked at and then published a post based upon input that went into silver mining over, I think, up to 1,000 years. But be that as it may, whether it's 2 billion troy ounces or up to 16 billion troy ounces, either way, at today's silver price, around $23 per troy ounce, we're looking at only between $46 billion and $370 billion in reclaimable above ground silver. And the upper end of that range, or $370 billion, is but 3% of reclaimable gold, virtually all of it ever mined, which itself amounts to roughly $1.3 trillion in investable accounts. All right. With global financial assets or investable assets at around 200 trillion, according to Credit Suisse, my prior employer, and with gold allocation around 0.07% of the total, 0.7%, it's a little less than 1%, of the total of all investable assets of roughly 200 trillion, and with virtually no silver holdings at all, just a minute reallocation towards gold will trigger a huge upward move in gold and, by extension, in silver. I'm talking gold and silver prices. Given the very limited annual mining output, about $200 billion worth of gold, about $20 billion worth of silver at current prices. And this also is a supply hurdle that is compounded by the fact that gold and silver are in increasingly firm hands, especially gold. My point is the big picture, the very small allocation in terms of investable funds, financial assets that have been set aside in gold and virtually none in silver, coupled with how little comes out of the ground, coupled with the fact that just a minute reallocation, the law of large numbers, 200 trillion times 1%, right, is 2 trillion. You're talking about a decade or more of mining that would have to supply that. So obviously it has to be supplied, that is higher allocation sought by investors, primarily through a higher equilibrium price. That is, limited supply will force a higher clearing price. And in my opinion, that fact and the fact that investors will insist on physical instead of paper, gold and silver, will overcome any and all manipulation, which have been substantial and long-lasting, especially as physical metal is demanded and contract settlement in fiat terms will be increasingly discredited, and thus the paper exchanges behind it. And paper money being discredited after that? I think so, increasingly. Speaking of which, all this less than happy fiat money news is just in time for the Fed, with its newest FOMC, Federal Open Market Committee member Judy Shelton, a former gold bug, having been brought into the fold, put onto the FOMC. But only after Ms. Shelton distanced herself from the yellow metal, and only after she effectively completely repudiated over quite a few months and publications and speeches the gold standard, sound money, limited government, and price discovery. She is now on board the Central Planning Express. How ironically fitting this would be, just as precious metals look like they will no longer be constrained by either manipulation or by Main Street media triggered ignorance. In short, precious metals look set to resume their canary in a coal mine function, alerting economic participants that unsustainable monetary and fiscal policies threaten their purchasing power, their wealth, and their prospects, their growth prospects, while rising social unrest in the U.S. is eating away at the very fabric of society, property right protections, and the rule of law over the rule of the jungle. I think we are witnessing a belated version of rising prices, rising precious metals prices in U.S. dollar terms that can no longer be pushed aside by either ignorance or manipulation. I don't think this sustained downward manipulation of precious metals price discovery via effectively naked shorts will continue to trump demand for physical metal settlement. I don't think that the increasingly discredited metal short exchanges will keep precious metals from blinking red through the bullion bank and central bank machinations fog to hold them back. Pardon me if Rudolph the Red-Nosed Reindeer comes to mind. That's all for today. I hope you get something out of this. Over and out from Niederweningen, Switzerland on July 23rd, 2020. Bye-bye.